design, create, communicate. I want that.
Welcome back to the deep dive. Today we are opening a door that I think a lot of people try to keep explicitly shut until the wolves are actually scratching at it. We're talking about money, not just the fun part, making money, but the actual gritty mechanics of getting the money you need to start or grow a business.
It's the fuel of the entrepreneurial engine. And frankly, it's the place where the engine usually seizes up. It's the single biggest point of failure.
Right. And, looking through the stack of research and the case studies for this deep dive, what really struck me is that financing, it isn't just math. I mean, obviously there are numbers, lots of them.
Oh, there are numbers.
But at its core, this topic is about power. It's about control. And maybe most importantly, it's about sleep specifically, how much of it you're going to get for the next 5 years.
That's a very, very accurate way to frame it. Because the decisions you make right at the beginning about where your capital comes from, is it a bank loan, is it an angel investor, is it your own credit card, that will dictate everything.
Everything.
Who you answer to, how fast you can grow, and essentially who owns your future. It's foundational.
So our mission today is to completely demystify the Canadian landscape of business funding. And I really want to emphasize that word Canadian because our ecosystem here, it's just different. It's not what you see on TV.
It's on Silicon Valley.
It's on Silicon Valley VCs just throwing money around at pizza delivery apps. We have a unique mix of, the big Bay Street banks, but also these really specific government agencies and even these tiny rural community lenders.
We do. And we want to move you, the listener, from that frantic, almost desperate question of where can I find cash to the much more strategic question, which is, what is the right kind of capital for my specific vision?
Because not all money is created equal.
Not even close. Some money comes with a partner. Some money comes with a parole officer. It's very different.
We are going to go deep today. We are not just skimming the surface. We're going to look at the psychology of it all. The real human feeling of taking on debt versus giving up a piece of your company, giving up equity.
And we're going to dissect real-world case studies, some huge Canadian successes, like a company called I Love Rewards, and some cautionary tales that honestly are a bit hard to read.
The story of Ladder Rail comes to mind. That one hurts to read.
It does, because you can see yourself in that person's shoes. It's such a common mistake.
Exactly. But we need those stories to understand the traps. So whether you are sketching an idea on a napkin right now or you're running a $10 million company looking to scale, this episode is your toolkit. So let's start at the very beginning, the starting line, or as I like to call it, the napkin math phase.
This is where the first and, like we said, often fatal mistake happens.
I feel like napkin math is almost a romantic term in business, You picture the founder in a coffee shop scribbling down numbers, having that aha moment. I need $50,000 and I can change the world.
It is romantic. It's the Genesis story everyone wants to have. But in practice, it's usually catastrophic.
Yeah.
The napkin math trap is this phenomenon where an entrepreneur lists out only the obvious things.
The tangible stuff.
The tangible stuff. Rent is $2,000 a month. I need $10,000 in inventory. A sign for the front door costs $1,000. They sum it up and think, okay, that's my capital requirement. That's the number.
And they are wrong.
They are almost always drastically, dangerously wrong. And this isn't just an, oops, I need another $5,000 kind of mistake.
Yeah.
Undercapitalization is one of the leading causes of bankruptcy in Canada.
That's a huge statement.
Well, think about it this way. If you build a bridge that only goes 90% of the way across the river, you don't get 90% of the traffic. You get zero traffic and a very wet car.
Okay, that's a good analogy. So let's make this real. Let's look at the case of Sid Stevens. This was a case study in the source material that I found really relatable, almost painfully so.
Sid's story is the classic example.
So Sid has a product. It's called the Ladder Rail. It's a safety device for ladders. He's ready to manufacture it. He sits down, does his math, and he figures he needs $170,000.
Right. And let's look at his list, because to a layman, to most of us, it looks pretty comprehensive. He's thought about it.
It looks good. He has a building for $100,000. He's got equipment for $30,000, a truck, another $30,000, and $10,000 for aluminum inventory to make the product.
You add it up, it's $170,000. He walks into the bank, probably feeling very prepared, very professional. He's got his numbers.
And the banker rejects him, flat out, which, reading it, felt really harsh. I mean, the guy had a list. He knew the price of the building. He'd done some homework.
He had a shopping list,
Mhm.
not a financial plan. And that's the crucial difference. The banker's rejection, when you break it down, highlighted 3 critical holes that Sid and thousands of entrepreneurs just like him completely missed.
Okay, what was number 1?
First, he was guessing on the costs. He didn't have firm quotes from suppliers or real estate agents. They were ballpark figures, and a bank hates ballpark figures.
Right, they want certainty.
They want certainty. But second, and this is way more important, he had zero proof he could actually repay the loan. He had no sales projections, no market analysis. He just had an idea and a shopping list.
But the third thing, this is the one that really caught my attention. The banker called it the operating requirement.
This is the killer. This is the gap. This is the valley of death for startups. Sid calculated the cost to buy the assets to start the business. He completely forgot about the cost to run the business before customers started paying him.
Can you explain that distinction a bit more? Because I think it's easy to get confused. If I open a store on Monday, aren't I selling things on Monday and getting cash?
You might be selling, but are you collecting cash? That's the real question. Let's say you open a manufacturing plant like Sid. You hired 2 people. You have to pay them on Friday. Cash goes out the door. You have to pay the hydro bill at the end of the month. Cash out. You have to pay rent. Cash out. But maybe you sell your product to a distributor, and they have net 30 or net 60 terms. That's standard. It means the customer doesn't have to pay you for 30 or even 60 days.
So money is going out the door instantly every single week, but money isn't coming back in for 2 whole months.
Exactly. That is the operating gap. That is the valley of death. You need enough cash in the bank to cover all of your expenses for that 2 to 6 month runway. And Sid hadn't budgeted a single dollar for it.
Wow. So he would have run out of money to pay his staff in the first month.
He would have gone bankrupt even if he was making sales. This is a terrifying thought for most people. You can be successful on paper with orders coming in and still go bust because of timing.
Profit is a theory. Cash is a fact.
That's the mantra. You cannot pay payroll with profit. You can only pay it with cash in the bank.
So to avoid being Sid, we need a better equation. The sources give us what they call the golden formula for capital requirements. It's not just a shopping list.
No, it's a real formula. It goes: capital requirements equals your startup costs plus your operating requirements minus any owner assets available.
Okay, let's break that down. Startup costs. That's basically Sid's list, right? The
Yeah.
building, the truck.
It is the hard assets, but you also have to include what we call soft costs, which most people forget.
Soft costs. What's that?
It's everything you spend money on that you can't touch or resell. Lawyers' fees to incorporate, accounting fees to set up your books, marketing for the launch, the grand opening banner, all that stuff.
And that adds up fast.
It adds up to thousands of dollars, and a bank typically won't lend you money for it because there's no asset to use as collateral. You can't repossess a lawyer's bill if the business fails.
Okay, so that's startup costs. Then we have operating requirements, which is that runway money we just talked about. And finally, minus owner assets available. This brings us to a really uncomfortable part of the process.
The personal net worth statement.
I can just imagine the scene. You're there to talk about your brilliant business idea, and suddenly the lender is asking about your personal savings account, the value of your car, how much you owe on your house.
It feels invasive.
It feels very invasive. A lot of entrepreneurs incorporate specifically to protect their personal assets. They think, the corporation is separate from me.
And in the eyes of the law, for liability, that's true. But in the eyes of a lender who is giving money to a brand new startup with no track record, no, you are the business.
So why do they need to see my personal finances?
They want to know you have skin in the game. It's that simple.
Yeah.
They want to know that you are personally invested and that it will hurt you if this fails.
So they want to know that if this goes down, I go down with it.
Essentially, yes. Because lenders rarely, if ever, finance 100% of a venture. They're just not going to do it. They typically require the founder to put up 20 to 50% of the total required capital as equity.
Wait, 50%. Let's be clear. If my calculations show I need $1 million to start this business, a bank might expect me to have $500,000 of my own money sitting in my bank account.
Or in assets you can pledge, yes.
That seems impossible for most people. That's a huge barrier.
It is the single biggest barrier, and it's why so many businesses never get off the ground. But you have to try and look at it from the bank's perspective. If you, the person with the vision, aren't willing to risk your own capital on your own idea, why on earth should they risk their depositors' money on it?
Okay, that's a fair point, even if it hurts to hear. So we've done the math. We've used the golden formula. We've calculated the startup costs, the soft costs, that crucial operating gap. We know how much skin we have in the game. Now we have a number, and we have to go get the rest of the money.
And this brings us to section 2, the Great Divide. This is the fundamental fork in the road for every entrepreneur: debt versus equity.
Every dollar you raise is going to come from one of these two buckets.
That's right. And I think the best way to really understand them is with an analogy. Debt is a rental. Equity is a marriage.
I love this. It makes it instantly clear. Let's unpack debt as a rental first.
Okay. When you take on debt, a bank loan, a line of credit, you are renting money. You pay a usage fee every month, which we call interest. That's your rent payment.
And you have a lease term.
You have a lease term, exactly, the repayment schedule. And at the end of that term, when you've paid it all back, you give the principal back, the keys back, and the relationship ends. You shake hands, and you walk away. It's clean.
It's purely transactional.
It's very clean. And crucially, the landlord, the bank, doesn't get to tell you how to decorate your apartment. They don't get to tell you what your marketing strategy should be. As long as you pay the rent on time, you are the boss. You retain 100% control and ownership.
And there's a tax benefit too, isn't there?
Correct. In Canada, the interest you pay on a business loan is generally a tax-deductible expense. So the government is effectively subsidizing your rent a little bit, which helps.
But the downside of renting is that you can get evicted. And you can get evicted pretty fast.
That is the massive risk. You have fixed, non-negotiable obligations. Whether you sell 1,000 units this month or 0 units, the bank expects that payment on the first of the month.
They don't care if you had a bad quarter.
They don't care. If your cash flow dries up and you start missing payments, the bank can foreclose. They can seize the assets you pledged as collateral. The stress of that monthly nut that you have to crack can be absolutely overwhelming for a founder.
Okay, so that's the rental. It's clean, you keep control, but it's risky. Now let's look at the alternative. Equity. The marriage.
Equity is selling a piece of ownership in your company. You find an investor, an angel, a VC. They give you a lump sum of cash, and in exchange, they now own a percentage of your company. It's a marriage because you are now partners, for better or for worse.
The immediate benefit I see here, and it's a big one, is cash flow.
It's a huge benefit. You don't pay monthly rent to an equity partner. If the business makes absolutely no money for 2 years while you're building it, you don't owe them a dime in payments during that time.
So all the cash you have can go back into growth.
Exactly. This is why high-growth tech startups almost always use equity financing. They can't afford to be servicing debt. They need every single dollar for hiring engineers and buying ads.
But you're married now.
You are married. And that means you lose autonomy. You can't just make decisions on a whim anymore. You have to consult your partner on big decisions. If they own a large enough chunk, they might even have veto power on a board of directors.
And unlike a landlord, you can't just move out at the end of the lease.
No. Divorcing an equity partner, buying them out, is incredibly expensive, messy, and sometimes legally impossible. You are tied to them until the company is sold or goes public.
The sources mention something called smart money in relation to equity. What does that mean?
That's the potential upside of the marriage. If you marry well, if you choose the right partner, they bring a lot more than just a check.
Their network.
Their network, their expertise, their mentorship. A good investor can introduce you to your biggest customer. They can help you hire a key executive. They open doors you could never open on your own. A bank loan doesn't give you advice. A good investor does.
But then there's the dark side. There's dilution.
Dilution. It's such a sterile financial word for what is actually a very painful emotional reality. It means owning less and less of your own creation.
Break that down for me.
You start with 100% of the pie. It's all yours. To get started, you sell 10% to an angel investor. Okay, you still have 90. Then, to grow, you sell another 20% to a VC firm. Suddenly, you only own 70%. If the company sells for $10 million, you only get $7 million.
I mean, $7 million still sounds pretty good to me.
It is, and financially, it can be the absolute right decision, provided the pie got big enough because of their money. But the psychological toll of not being the full owner anymore, of having to answer to others about your own idea, is what really surprises founders. It can be tough.
Before we move on from this section, I want to touch on a slightly more technical concept from the reading: financial leverage. It sounds like something you'd hear in a Wall Street movie, but can we break it down simply?
We can. Financial leverage is basically using borrowed money debt to increase your potential return on investment. In simpler terms, it's gambling with someone else's chips.
Okay, give me the math on that. Make it concrete.
All right, let's say you have an opportunity to invest in a project. You've done the math, and you know it will return a 15% profit. You could use $100,000 of your own money, and you'd make $15,000. 15% return. Great.
Solid.
But what if you went to the bank and borrowed that $100,000 at 8% interest?
So I'm paying 8% for the money, but I'm earning 15% with it.
Exactly. You pocket the difference. That 7% spread, $7,000 in this case, is pure profit you made on money that wasn't even yours. You've used the bank's capital to make yourself richer. If you do that with $1 million, your personal return on investment skyrockets. You are leveraging the bank's cash.
But leverage is a double-edged sword, isn't it? It has to work both
Yep.
ways.
It cuts very, very deep on the downside. What if you borrow that $100,000 at 8%, but the project goes sideways and only returns 4%?
Oh.
You are now losing money on every single dollar you borrowed. You still owe the bank the full $8,000 in interest, but you only made $4,000. You've just lost $4,000. This is how companies can wipe out all of their owners' equity incredibly quickly. High leverage means high risk, high reward.
So we have the theory, the big divide. Debt is a rental, equity is a marriage. Now let's look at what actually happens on the ground in Canada, because I feel like we talk a lot about venture capital and Shark Tank, but that's not the reality for most people starting a business.
Not at all. It's not even close. The reality for the vast majority of Canadian entrepreneurs is much grittier, much less glamorous.
And the statistics bear that out. One of the sources said that 54% of Canadian entrepreneurs rely primarily on their own personal savings.
More than half. Which brings us to Section 3, bootstrapping.
Bootstrapping. The name itself sounds rugged, doesn't it? It sounds like pulling yourself up by your own bootstraps when you're stuck in the mud.
It is rugged, and that's exactly what it is. Bootstrapping is the art of financing your business through its own operating revenue, your personal resources, and a whole lot of sweat equity.
It means you aren't waiting for a white knight investor to ride in and write you a check.
No, you're the one funding the growth. You are the bank.
And it's not just about emptying your savings account into the business. The sources list some really creative and sometimes, let's be honest, desperate techniques for survival.
It's all about cash preservation. How do you survive until you have enough customers to pay the bills? A classic technique is leasing instead of buying. Instead of spending $50,000 of your precious cash on a piece of manufacturing equipment, you lease it for $1,000 a month. Yes, you'll pay more in the long run, but you keep $49,000 of cash in your bank account for making payroll today. That's the trade-off.
What about this idea of trade credit? That one seemed really powerful.
Oh, this is huge. And it's an unsung hero of small business finance. If you can convince your supplier, the person who sells you raw materials, to give you those materials now and let you pay them in, say, 90 days.
Your supplier has effectively just given you a loan.
A massive interest-free loan for 90 days. You get to take their materials, turn them into a product, sell it, and collect the cash from your customer before you have to pay your supplier. You are funding your business using your supplier's money.
But that all comes down to relationships and negotiation skills, right? You have to have the credibility to pull that off.
You do. And then there's a more formal version of that called factoring. This is where things get a little more hardcore.
Yeah.
You sell your accounts receivable, your unpaid invoices, to a third-party company
Why would I do that?
because they give you cash immediately.
Yeah.
Let's say you have a $10,000 invoice that your customer won't pay for 60 days. A factoring company will give you, say, $9,500 for tomorrow. They keep the $500 difference as their fee.
So you're paying $500 for speed.
You are. It's expensive money. That's a 5% interest rate for 60 days, which is very high. But if you need to make payroll on Friday, and that invoice is your only source of funds, factoring saves your life.
And then, of course, the biggest bootstrapping technique of all is just not paying yourself a salary.
Sweat equity. It's the most common form of capital in a new business. Founders often take zero salary for the first year or 2 years. They live off savings or a spouse's income. They are subsidizing the business with their own free labor.
The pros of bootstrapping are pretty obvious. You keep 100% control. You don't have a banker breathing down your neck. You don't have an investor telling you what to do. You are the captain of your own ship.
And it forces incredible discipline. When you are literally spending your own grocery money on a Google ad campaign, you make damn sure that campaign works. You don't waste resources on fancy office furniture or expensive lunches.
But the cons are just as big.
The cons are significant, and they're what limit most bootstrap businesses. Your growth is completely tied to the depth of your own wallet. You might see a massive opportunity in the market, a chance to expand, but if you can't afford to hire the sales team to seize it, you just have to watch that window of opportunity close.
And a competitor with funding might just come in and crush you.
They can crush you just because they can afford to move faster. It's a huge risk.
There was a success story in the notes that I thought was a really fascinating twist on bootstrapping. It was a company called Alpine Environmental Ltd. This wasn't startup, it was a management buyout.
This is a great story because it shows how creative you can get. Kathy Reich and her partners were employees at this company. The owners were retiring and wanted to sell. The employees wanted to buy it.
But they're employees. They don't have millions of dollars sitting around to buy a whole company.
Exactly. So how did they do it? They went to the Business Development Bank of Canada, the BDC, and used a product called subordinate financing.
Okay, that sounds complicated.
It's kind of a hybrid. It's a loan, but it's structured more like equity. It's a loan that is based on the company's future cash flow, not just its hard assets like buildings and trucks.
So the BDC was betting on the management team's ability to keep the company profitable.
Precisely. Now, because it's riskier for the lender in a bankruptcy, they get paid last. After the traditional banks, the interest rate is higher. But it was the only way to make the deal happen. It allowed the employees to buy the company, essentially using the company's own future earnings to pay for the purchase.
That is incredibly clever. They bootstrapped an entire acquisition.
Exactly. It just goes to show that bootstrapping isn't just about being cheap. It's about being creative in how you structure deals so the business can pay for itself.
Okay, so let's say we've tried to bootstrap, or we know from the start that our idea is too big for it. We need outside money. In Canada, the first, most obvious stop is usually the bank. And that brings us to Section 4, the debt landscape.
The big six, RBC, TD, Scotiabank, BMO, CIBC, National Bank. They are the landscape.
Yeah.
They hold something like $50 billion in small business loans. They are the gatekeepers.
But here is the friction point. I hear this from entrepreneurs constantly. The bank won't lend to me. They run all these ads saying they support small business, but when I walk in the door, they just say no.
And look, the entrepreneurs are right to be frustrated, but to have any chance of success, you need to understand the bank's position. Banks are not venture capitalists. They are lending out depositors' money.
Your grandmother's savings account.
Literally, your grandmother's GIC. They are heavily regulated. They cannot, by law and by nature, take wild risks on unproven ideas.
So they are risk-averse by design. It's a feature, not a bug.
Completely. And to get a yes, they need three things, the classic 3 C's of credit. Collateral, which is assets they can seize, cash flow, which is proof you can make the payments, and a good credit history. A startup usually has none of these three things.
A startup has an idea and a PowerPoint deck.
Exactly. And you can't repossess a PowerPoint deck. That is why the rejection rate for true startups at the big banks is so high.
However, it's not impossible. The key, according to the research, seems to be something called relationship banking.
This is so critical and so often overlooked. We saw this with the case study of Alan Waxman from Waxman Recycling. This is the guy who'd been with the same bank for 35 years, decades, a loyal customer.
You'd think they treat him like royalty.
You'd think. But he started feeling like just an account number. The service dropped, they weren't proactive, they didn't understand his business's changing needs. He was literally days away from walking across the street to a competitor.
And this is where the human element comes in. A single person.
Enter Mary Jo Lopes. She was a banker who actually did her job. She saw this valuable account was about to leave. She stepped in, she took the time to learn his business, she offered personalized advice on how to restructure his debt to save thousands in interest. She didn't just save the account, she rebuilt the trust.
The lesson there seems so simple, but so powerful. Build the relationship before you are desperate for the money.
Exactly. Don't let your first meeting with a bank manager be on the day you need an emergency loan to survive. Go in when you don't need money. Open your business account there. Invite the manager to your shop for a tour. Show them what you do. Make them believe in you as a person so that when you do need the loan, you aren't a stranger on a spreadsheet. You're a person they know and trust.
Now, if the bank says no, and for many startups it will, where do people go? Often they just open their wallet and pull out a piece of plastic.
The credit card trap. The statistics on this are genuinely shocking. 59% of Canadian small businesses use credit cards for startup expenses. And for 23%, they call it their most important source of funding.
That scares me. That really scares me.
It should. It's the definition of a false economy. It's accessible. You have the card in your pocket right now. You don't need a meeting or a business plan to use it.
Yeah.
But the interest rates are 19%, 20%, sometimes higher.
And it compounds daily.
Rapidly. If you miss a payment or can't pay it off in full, you enter what's known as a debt spiral. Your minimum payments are just covering the new interest charges. They're never touching the principal. You are treading water while wearing lead boots. It should be an absolute last resort, or a very, very short-term bridge like 30 days max. It is not and should never be a source of long-term capital.
Okay, let's pivot from the private sector to something that feels uniquely Canadian in its scope. We have a very robust system of government sources. This is Section 5.
This is the soft money. And it's a crucial differentiator for Canadian entrepreneurs versus, say, their counterparts in the U.S. The government, both federal and provincial, has a vested interest in seeing small businesses succeed.
Because it creates jobs and tax revenue.
Exactly. Their goal is economic stimulation. So they're willing to take on risks that the big six banks simply won't touch.
So is this free money? Are we talking about grants?
Rarely free money. There are some grants out there for very specific things like R&D, but mostly we are talking about loans. But they are patient loans. And that's the key word.
Explain the difference. What is a patient loan?
A commercial bank wants their money back as quickly as possible with interest. They have shareholders to answer to. A government lender, like the Business Development Bank of Canada, the BDC, has a different mandate. Their shareholder is the Canadian public. They want the business to succeed in the long run, so it creates tax revenue and jobs 5 years from now.
And the BDC is a monster in this space. I saw a stat over $11 billion in loan authorizations.
They are the bank for entrepreneurs. That's their tagline. And in many ways, it's true. The case study of Smoke and Grill is the perfect example of why they exist.
Tell us about Tom Piros and Roger Smith. What was their situation?
So these guys have a product, a high-end barbecue grill. They're manufacturing it in Canada. They need $150,000 specifically for marketing and building up inventory for a U.S. launch.
Okay. So they go to a traditional bank.
They go to a traditional bank. The bank looks at their request and says, okay, you want money for marketing and inventory? I can't take that as collateral. If your business goes bust, I can't repossess your brochures or your unsold barbecues.
The bank says no.
The bank says no, it doesn't fit the model. But the BDC looks at the exact same proposal differently. They see the export potential. They see a Canadian manufacturer creating jobs and expanding into the U.S. market. That fits their mandate.
So they provide the $150,000.
They do. But here is the magic part that a private bank would never do. The terms.
This is what saved them, right? The repayment structure.
Yes. The BDC offered them flexible repayment. They said, we understand that when you launch in a new market, you won't have positive cash flow immediately. So for the first full year, you only have to pay the interest on the loan. No principal payments.
That would lower the monthly payment drastically.
It preserves cash flow right at that critical startup phase. It gives them breathing room. That little bit of patience allowed Smoke and Grill to survive the valley of death and become a huge success. A traditional bank's computer algorithm simply doesn't have a button for that kind of flexibility.
And there's another program that stood out, which is even more grassroots. It's specifically for rural Canada, Community Futures.
I love this network. These are over 200 locally run nonprofit offices in rural communities across the country. And the decisions are made locally by people who understand the local economy.
The story of Heather Boyd really highlights this perfectly. She wanted to open an office supply store, Boyd's Basics, in Warren, Manitoba.
And the population of Warren, Manitoba is 800 people.
800 people. You can just imagine the risk assessment team at a big six bank in a skyscraper in Toronto looking at a spreadsheet. They see population 800, and the file is automatically stamped reject.
It doesn't fit their risk profile. It's too small. But the local Community Futures office in that region looked at the exact same proposal and saw something completely different.
What did they see?
They saw a community hub. They saw a vital service that the town needed so that people didn't have to drive an hour to Winnipeg just to buy printer paper. They saw a local person creating local jobs.
So they loaned her the $125,000 she needed.
And it wasn't just the money. They helped her write her business plan. They provided ongoing mentorship. And the result? She built a thriving business that now employs 18 people in a town of 800. That is a massive economic impact. That is the social return on investment that these programs are looking for.
Okay, so government money is patient, it's mission-driven. Is there a downside? It sounds too good to be true.
The downside is that it's slow. and it's bureaucratic.
Sure.
The application forms can be an inch thick. The reporting requirements are very strict. You have to prove you are creating the jobs or having the impact you promised.
And it's political.
And it's political. Because it's government money, the priorities can shift. A program that is available today might be cut in the next federal budget. You can't always count on it being there.
So patience is required to get the patient money. Okay, let's swing back to the private sector, but this time, let's talk about the people who want to shoot for the moon. Section 6, equity sources angels and venture capital.
This is the sexy part of financing. This is what you see in the movies. This is Shark Tank and Dragon's Den. But we have to be clear. This type of funding applies to a tiny, tiny fraction of businesses.
Let's start with angels. Who are these people? Are they actual angels?
They can feel like it when they write the check.
Yeah.
Angel investors are typically wealthy individuals. Very often, they're former entrepreneurs who successfully built and sold their own businesses, and now they want to invest in the next generation.
And they fill a very specific gap in the funding ecosystem, don't they?
They fill the crucial gap between friends, family, and fools who might give you $20,000 and venture capital funds who usually won't even take a meeting for less than a $2 million investment. An angel's check size is typically in that sweet spot of, say, $100,000 to $500,000.
And what do they want in return for their halo and their cash?
They want a financial return, and a big one. They're often looking for a 30 to 40% annualized return. But because they are individuals investing their own money, they often care about more than just the numbers. They want a mentor. They want to be involved. They're investing in the founder as much as the idea.
Then you have the next level up, the venture capitalist. The VC.
VCs are a different species. They are professional money managers. They are not investing their own money. They are managing a massive pool of money that comes from pension funds, university endowments, and other large institutions. Their job is not to be nice. Their job is to generate massive returns for their investors.
They are not looking for singles and doubles. They are only swinging for home runs.
They are swinging for grand slams that leave the park entirely. They're looking for unicorns. Their business model is built on the fact that 8 out of 10 of their investments will probably fail and go to zero. So the 1 or 2 that succeed need to return 100 times their investment to make up for all the losses.
Which means they are only interested in businesses with massive growth potential.
Massive, global, scalable potential, and a clear exit strategy. They need to know how they're getting their money back, and then some, within 5 to 7 years, which usually means an IPO or selling the company to a giant like Google or Microsoft.
The case study of Razor Suleiman and his company I Love Rewards is the definitive Canadian VC story in the research.
It is. And it's perfect because Razor started out as the ultimate bootstrapper. This is the guy who was selling hockey cards as a kid. In college, he ran a custom t-shirt business out of his dorm room. He knew how to hustle and make a dollar.
But his business, I Love Rewards, hit a ceiling.
He hit a growth ceiling. He had a great business in Canada, but he realized that to enter the massive U.S. market and compete with the big American players, he couldn't do it on his own cash flow. It was just too slow. He needed millions of dollars, and he needed it now, to hire sales teams in 10 cities at once and build out his technology.
So he took the money, he raised a Series A, then a Series B round, millions and millions of dollars from VCs.
And it worked. The company exploded. Sales tripled. It became a major international player in the employee reward space. But the trade-off was explicit, and it was huge. He lost his majority interest in the company. He owned less than 50% of the company he founded from scratch.
He had a quote in the material that was just so stark. He said, "You either have to give up control to get big, or you stay small."
And that is the fundamental trade-off of venture capital. There's no ambiguity. If you want to build a kingdom that you rule forever and pass on to your children, do not take VC money. If you want to build a rocket ship that might explode on the launch pad or might reach Mars, then take the money. But you have to know that you are now a pilot, not the owner of the airline.
Before we leave the world of equity, we have to mention the new kid on the block. Crowdfunding, things like Kickstarter, Indiegogo, or even equity crowdfunding platforms.
It's a fascinating model because it democratizes access to capital. You can raise money from thousands of small backers instead of one big one. And it's fantastic for something called market validation.
What do you mean by that?
Well, if you launch a campaign for a new gadget and 5,000 people pre-order it, you've just generated irrefutable proof that people want to buy your product. That's incredibly valuable data that you can then take to a bank or an angel investor later on.
But there's a flip side. The risk is your reputation.
Absolutely. If you launch a big, splashy campaign and nobody backs it,
Yeah.
you have just failed very publicly. The whole world knows that nobody wants your product. And people underestimate the work involved. Running a successful crowdfunding campaign is an exhausting full-time marketing job for 30 days straight. It is not easy money.
Okay, so we've surveyed the entire landscape. We know who has the money, from the local credit union to the Bay Street VC. Now we need to convince them to actually give it to us. This brings us to section 7, the pitch. The sources highlight 3 specific criteria that every lender or investor evaluates.
We sometimes call these the 3 C's of lending, but in this context, it's management ability, the proposal itself, and your creditworthiness or collateral.
Let's start with management ability. This one feels a bit subjective, a bit fuzzy. How do they judge that?
It is subjective, but it's arguably the most important one. This is the classic jockey versus the horse debate. Most experienced investors will tell you they bet on the jockey, the founder, more than they bet on the horse, the business idea.
So they're betting on me personally.
They're betting on you. Do you know your industry inside and out? Have you done your homework on your competitors? If you come into the pitch meeting and you're disorganized, you can't answer basic questions about your market size. The lender assumes you will run the business with that same lack of preparation.
Then there's the proposal itself, the formal business plan. We have a great redemption story here with Michael Din and Heidi Noble.
The winery story. I love this one because they failed first, which is so common. They had this dream to start a winery in the Okanagan Valley in BC. I mean, who wouldn't want that job?
Sounds amazing.
They had the passion, they had the winemaking skills. But their first proposal to the bank was, well, it was fluffy.
Weak on the numbers.
It was weak on reality. It was full of passion, but didn't show a clear, believable path to positive cash flow. They hadn't fully understood the complex regulatory environment for selling alcohol. The bank, unsurprisingly, rejected them.
But they didn't give up.
No. And this is the key. They took that no, not as a final judgment, but as feedback. They went back. They educated themselves on the business side of the industry. They tightened all of their financial projections, and they came back a year later with a bulletproof plan. And they got the funding.
So a no isn't always a never.
Often it's a not yet, or more accurately, not like this.
And the third criterion, creditworthiness. This goes right back to that uncomfortable personal net worth statement we talked about.
It's the hard reality of collateral. At the end of the day, if you default on the loan, what can the bank seize to get its money back? The statistics are sobering. 53% of entrepreneurs have to give a personal guarantee. 40% have to pledge their family home as collateral.
You're literally betting the house.
You are literally betting the house. You have to have assets to unlock assets.
There is a really important piece of strategic advice in this section that I want to highlight because it's a mistake I think a lot of people make. It says, match the financing term to the asset life. What does that mean in plain English?
It means don't use long-term money for short-term problems and vice versa. So don't use a 20-year mortgage to pay for this week's payroll. And please, do not use a high-interest credit card to buy a building.
Why is that mismatch so bad?
Well, think about it. If you use a credit card with 20% interest to buy a machine that's going to last for 10 years, you will end up paying 3 times the actual price of that machine in interest payments over its life. It's financial suicide.
And the other way around.
Conversely, if you take out a 20-year loan to buy inventory that you're going to sell next week, you will still be paying interest on that long-gone inventory for 19 years after you've sold it. It makes no sense.
So short-term money, like a line of credit, for short-term needs like inventory and payroll. Long-term money, like a mortgage, for long-term assets like buildings and heavy equipment.
Exactly. Mismatching those is a classic rookie mistake that absolutely destroys cash flow.
We're almost at the end of our deep dive, but we cannot finish this without talking about Section 8, the human element. Because all of these spreadsheets and term sheets, they hide the fact that this process is incredibly emotional and stressful.
It is the most stressful part of running a business, without question. The first psychological burden is just dealing with rejection. You're going to hear no a lot. You have to develop a callus on your ego. You cannot take it personally, even though it feels intensely personal.
It's your dream they're rejecting.
It is, but you have to see it as a rejection of the proposal, not of you.
Then there is the stress of the debt itself once you get it.
The must-pay pressure. It hangs over you every single day. And it changes your brain. It can make you overly conservative. You stop taking calculated risks because you're terrified of missing a payment. It can lead to serious health issues, insomnia, anxiety, burnout. We see this all the time with founders.
And on the flip side of the coin, for those who go the equity route, there's the pain of dilution. Even if you know, logically, that selling 40% of your company was the right strategic move to grow, seeing that you only own 60% on paper, it hurts.
It can breed resentment, even unconsciously. I've seen founders lose motivation because they start to feel like they're just employees working for their investors. That thought creeps in. Why am I killing myself working 80 hours a week if the VCs get half the upside? It can poison the company culture from the top down.
And finally, a really stark warning in the source material about predators.
Because desperation is blood in the water for sharks. When a business is desperate for cash, that's when the predators appear. Merchant cash advances, predatory online lenders. They will promise you money fast, with no paperwork, cash in your account in 24 hours.
It sounds too good to be true.
Because it is. The effective annual interest rates on those products can be 50%, 80%. I've seen them over 100%.
Well, that's not financing, that's loan sharking with a fancy website.
It is. And it will kill your business much faster than having no money at all. You have to always read the fine print. If a deal seems too easy, too good to be true, it is always, always a trap.
This has been a massive journey through the entire Canadian financing landscape. Let's try to synthesize this for the listener. What are the big takeaways?
If I had to boil it all down to one thing, it's this. Financing isn't a one-time transaction. It's not something you get and then you're done. It is an ongoing strategic discipline. You are constantly balancing risk, which is debt, control, which is equity, and speed, which is cash flow.
And my takeaway from all of this is that the best money isn't just the one with the lowest interest rate on the page.
No, not at all. The best money is the money that aligns with your personal values and your long-term life goals. If you want to build a family business that you can pass on to your kids, you should probably stick to banks and bootstrapping. If you want to change the world in 5 years and then be on a beach, you should probably go talk to VCs. Don't mix those two paths up.
All right, here is a provocative thought to leave you with, something to mull over. We live in a world now where capital is becoming increasingly accessible through technology. Crowdfunding platforms, fintech apps. It's easier than ever to click a button on your phone and get a loan or an investment. The friction is disappearing.
But that friction was also a safety feature.
Exactly. So here's the question. Does this new ease of access make the gatekeeper role of the traditional bank less relevant? Or does it just make the risk of over-leveraging yourself and getting into serious trouble more dangerous? Precisely because there is no one there to tell you no.
That is the $100 billion question for the next decade of entrepreneurship. Just because you can borrow money with 3 clicks, it doesn't always mean you should.
Something to think about. We encourage you to look at your own venture or your own idea and ask yourself that hard question we heard earlier. Am I building a pie to sell, or am I building a kingdom to rule? Your answer to that question determines everything about your financing strategy. Thanks for listening to this deep dive.
See you next time.
Design, create, communicate. I want that.